Welcome to The Explainer. Today, we're unpacking a massive story that perfectly captures both the thrilling highs and the dangerous structural realities of the modern digital asset market. We're looking at the absolute explosion of the Unibase token, which is a project promising to completely revolutionize artificial intelligence. But we aren't just stopping at the tech. We're actually going to zoom out and look at the broader macroeconomic implications of this kind of extreme crypto volatility. Specifically, we want to look at how these massive market swings impact global emerging markets. It's this incredibly fascinating intersection of cutting-edge AI and global finance, and I'm super excited to break it all down for you today. Okay, let's dive right into this. Here's our roadmap for today's explainer. First, the Unibase price surge. Second, powering autonomous AI agents. 3, the anatomy of a value trap. 4, the emerging market impact. And finally, 5, innovation versus extreme risk. Let's get started. Section 1, the Unibase price surge, focusing on this massive market action. Let's just go ahead and acknowledge the elephant in the room, the explosive charts that have absolutely everyone in the market talking right now. 686%. According to recent data from CoinMarketCap, Unibase posted this staggering pump over just a 30-day period. It has completely dominated the market narrative, pushing its market cap to hundreds of millions of dollars and drawing in a massive wave of retail interest. Now, when you see a number like this, it is so easy to get caught up in the hype, right? But as focused learners, we really have to look under the hood to see what's actually driving it. You see, a major catalyst for this surge wasn't just organic, slow-building adoption. As noted by the crypto analysis channel Logic Ledger, this spike was heavily driven by a new perpetual contracts listing on the OKX exchange. And get this, it offered traders up to 20x leverage. When you introduce that level of leverage to a highly anticipated AI token, it acts as absolute rocket fuel. It exposes the token to a massive base of high-risk speculative traders who are just looking to magnify their short-term returns. Now, what's really interesting about this slide is what these numbers tell us about market health. To put it in perspective, a healthy, sustainable mid-cap project usually sees its daily trading volume sitting around 5 to 15% of its total market cap. Well, Unibase completely shattered that, with daily trading volume hitting nearly 21% of its market cap. Analysts warn that this heavy tipping of the scale signals intense, potentially unsustainable speculative activity rather than organic, utility-driven growth. It's a glaring red flag that the price action is being driven by leverage, not long-term holding. Section 2, powering autonomous AI agents and solving AI amnesia. So, if the trading is highly speculative, what exactly are they trading? Let's shift gears to examine the actual Web3 technology Unibase is building, because honestly, the narrative here is incredibly compelling. Unibase is designed to solve a very specific and, let's face it, very frustrating problem known as AI amnesia. Think about the standard AI chatbots we use every day. They're stateless. Every single time you start a new session, they forget who you are, what your preferences are, and what you talked about yesterday. They're great for one-off tasks, but they totally fail at complex, persistent tasks because they lack continuous memory. Unibase is building the decentralized infrastructure to permanently change that. To solve this AI amnesia, Unibase built a highly specific 3-part architecture. First is Membase, which is their decentralized memory layer. It uses zero-knowledge proofs to securely store an AI agent's long-term history without leaking your private data out onto a public blockchain. Second is the AP protocol. Think of this like a universal translator that allows an AI agent on one platform to seamlessly communicate and share knowledge with an agent on a totally different platform. And third is Unibase DA, a data availability layer capable of processing 100 gigabytes per second with sub-100 millisecond latency. I mean, that is an absolute superhighway for machine data. But here is where it gets truly fascinating. Unibase isn't just giving agents a memory, it's giving them an actual economy. They've launched the ERC 8183 agent service market alongside ERC 8004 identity passports and X402 machine-to-machine payments. So what does this mean in plain English? It means an AI agent like Hermes or maybe a DeFi copilot like BlazePay can now autonomously find, hire, and pay another AI agent to complete a task, and then settle the transaction instantly using the UB token. No human approval clicks required. They are literally building a true open agent internet. Section 3, anatomy of a value trap. So we're evaluating the risks here. The technology sounds revolutionary, right? But as investors and learners, we have to pivot sharply to evaluate the structural risks. Is this incredible technology actually a safe investment vehicle? To answer that, we need to bring in a classic investing concept, The value trap. A value trap is an asset that looks absolutely fantastic on paper. Maybe it has groundbreaking tech or a seemingly low entry price. So you think, wow, I'm getting a massive bargain. But in reality, the asset is structurally flawed, often by impending supply pressures or poor management. Meaning, the price is low for a very good reason, a reason that the broader market might be totally ignoring. And this brilliantly illustrates why researchers are raising the alarm about Unibase. Just look at this token distribution. Only 25% of the 10 billion maximum supply of UB is currently in circulation. A staggering 75% is locked away for the team, advisors, the treasury, and the ecosystem. And all of those locked tokens are sitting right behind an 18-month cliff. When that cliff hits, a massive, relentless flood of new tokens is going to dilute the market. For the price to just stay flat, real-world demand has to somehow outpace that massive upcoming inflation. So, we're looking at a striking contrast here. On the bullish side, the tech is absolutely real. They have a live agent market and over 12 million memory entries on their testnet alone. But on the bearish side, you have some truly terrifying tokenomics. Not only is there that massive 18-month cliff dilution waiting to happen, but security researchers have flagged severe centralization risks. Get this, the development team currently retains the ultimate authority to unilaterally freeze or mint new tokens. That is a massive central point of failure that fundamentally contradicts the whole ethos of a decentralized network. Section 4, the emerging market impact. Let's take the macroeconomic view. Now let's zoom out. Why does this specific token structure even matter to the rest of the world? Well, we are going to look at the macroeconomic impact of highly volatile, heavily leveraged crypto assets on vulnerable economies, drawing directly from extensive data published in the IOSR Journal of Economics and Finance. First, we have to understand why emerging markets are adopting crypto at lightning speed in the first place. For so many people in developing nations, it's not about getting rich quick. It is about pure survival and inclusion. Crypto offers much cheaper and faster cross-border remittances compared to traditional banking. It acts as a critical hedge against local hyperinflation. It provides instant financial inclusion for massive unbanked populations using just a smartphone. And it opens up entrepreneurial access to global capital through decentralized finance. Let's move to the next slide and see how this builds into real-world consequences when extreme volatility hits. In Nigeria, for example, citizens heavily rely on crypto for remittances, but when a highly leveraged asset crashes, users suffer massive peer-to-peer losses with absolutely no legal recourse or safety nets. Down in Argentina, while stablecoins provide a vital inflation hedge against the peso, retail investors get lured into altcoin speculation and end up facing devastating wealth wipeouts. And in India, you literally have over 100 million retail investors exposed to shock market corrections, which is then compounded by heavy, sudden taxation policies. The macro reality check from the research is, frankly, pretty sobering. While 20x leverage pumps on OKX are thrilling for day traders, they pose a severe systemic risk to unhedged retail participants in emerging markets. When these assets crash, it disproportionately destroys the wealth of low-income participants who simply don't have the capital to weather the storm. Furthermore, the mass flight to these volatile digital assets can actively undermine a developing nation's monetary sovereignty, which makes it even harder for central banks to manage their own local economic crises. Section 5, Innovation versus Extreme Risk. This brings us to our final section, where we really have to balance these two massive forces, the incredible, undeniable potential of Web3 and AI innovation against the very real extreme economic risks it introduces to the global market. For Unibase specifically, they are in an absolute race against the clock to build undeniable real-world utility before their heavy token unlocks begin to dilute the market. They launched the agent market in May 2026, but the real make-or-break moment is going to be the release of AIP 2.0 slated for Q2 2026, which promises true cross-platform memory sharing. Looking further out into the future, they aim to deploy 1 million memory nodes to fully decentralize the network. They desperately need to hit this timeline to generate enough protocol fees to offset the upcoming inflation. And on a global scale, emerging markets are facing two very different potential futures as they adapt to this technology. In the optimistic scenario outlined by researchers, we see safe, regulated financial inclusion driven by stablecoins and central bank digital currencies, alongside proper investor education. But the pessimistic scenario? It's dark. Rampant scams, massive wealth loss from speculative value traps, and worsening currency crises as capital just flees local economies. The determining factor between these two futures will absolutely be smart adaptive regulation and deep financial literacy. So, the crucial point is this. As we watch the Unibase ecosystem attempt to build the memory layer for an entirely new internet of autonomous AI agents, we really have to look past the 686% hype. We must weigh the groundbreaking technology against those glaring centralization risks and the heavy dilution overhang. Will it become the foundation of the AI economy, or is it just a high-tech value trap waiting to spring on retail investors? I hope this explainer has given you the framework to cut through the noise and evaluate these complex ecosystems for yourself. Keep learning, keep analyzing, and I'll catch you in the next explainer.